At the very heart of trading, there's always one big question. What is a stock actually worth? Today, we're going to cut through all the market noise and the hype to find a stock's correct price. And we're going to do it using a really powerful concept called fair value.
Let's be real. The market is driven by emotion, by noise, by speculation. It can be pretty chaotic. But what if you had an anchor, a reliable price that just cuts through all that chaos and gives you a clear, solid reference point for your trades? Well, that's exactly what fair value is all about.
So what is it exactly? Well, fair value isn't just some random line you draw on a chart. It's a price that's actually rooted in a company's real financial performance. Think of it like a mathematical foundation that helps you figure out if a stock is cheap, if it's expensive, or if it's priced, well, just right.
And you know what? The math behind it is surprisingly simple. All you do is multiply the price-to-earnings ratio, that's the PE, by the earnings per share, or EPS. And we use data from the trailing 12 months, or TTM. That just means the calculation is based on how the company actually performed over the last year, not on some guess about the future.
So why should you care about this? Because this simple little calculation removes a huge amount of the guesswork from trading. I mean, instead of just chasing a price up and down, you get a solid reference point that's grounded in real numbers. It's truly where a stock's price and its fundamental performance meet.
Okay, so we've got our number. Now for the fun part. Let's dig into how you can actually use it by reading the story the market is telling us. When a stock trades above or below its fair value.
This really creates two key scenarios. So, when a stock's price is below its fair value, we consider it undervalued. And what's cool is that the price will often gravitate back up towards that level, which can create a great mean reversion trade. But when the price is above fair value, it's overvalued. That's a sign of market euphoria, and it usually means the logical price target has already been hit.
And that leads us to a really critical question. If a stock is undervalued, if it's on sale, does that automatically make it a screaming buy? Well, the answer, maybe surprisingly, is a definite no. There's a huge warning sign we need to look out for first.
30%. This number is a massive red flag in the world of trading. Seriously, when you see a stock down this much from its highs, it's telling you something way more important than just, hey, it's cheap.
This is what we call the 30% bear market rule. A drop this big often means there's a serious structural shift happening with the company. The market isn't just giving you a discount. It might be intentionally pricing the stock lower because it expects things to get worse. You know, some stocks stay cheap for a very, very good reason. Now, let's talk about that other state, euphoria. So, a typical trade might start like this. You find an undervalued stock, you get in, and you set your target at fair value. And boom, the price hits it. Perfect trade. But then it just keeps going. That breakout above fair value, that's when the market is officially in a state of euphoria.
And listen, this is probably the single most important rule to remember about euphoria. Once your target's been hit, the whole game changes. The market is now being driven by pure emotion. This is the time for people already in the trade to take their profits. It is absolutely not the time to be looking for a new entry.
Okay, so you might be thinking that fair value is this static, fixed number, but it's not. It can, and it does, move. So let's take a look at why that happens and, more importantly, how to avoid some of the common traps that come with it.
You know, a price just breaking out above fair value can be really deceptive. If there isn't a powerful catalyst driving it, these breakouts often just suck in a bunch of hopeful buyers only to reverse and fall right back down. That classic move is called a bull trap. And trust me, it catches a lot of traders off guard.
So, what kind of things can legitimately change a stock's fair value? Well, it takes pretty significant new information. We're talking about game-changing technology, explosive revenue growth, or major shifts in capital spending, or CapEx. And on a bigger scale, major economic news, like inflation data from the CPI report or big announcements from the Fed, can cause investors to reprice the entire market.
All right, we've covered a lot of ground here. The theory, the warnings, and all the little nuances. So now let's put it all together into a practical framework that you can actually start using in your own trading. So where's the best place to get in? We can actually identify specific zones for high probability entries. Now the safest bets are always below fair value. Looking at the data, a stock that's at least 1.6% below enters a high probability zone. But the real sweet spot, That's when a stock is 3% or more below. At that point, it's considered pretty significantly undervalued, and the odds of it snapping back to fair value go up dramatically.
Of course, no single indicator is a magic bullet. It doesn't work in a vacuum. And that brings us to one of the oldest and probably truest sayings in all of trading. It just doesn't matter how perfect a setup looks if the entire market is moving against you.
And this brings us to the final and maybe most critical piece of the puzzle. You have to align your trade with the bigger market trend. I mean, a perfectly undervalued stock in the middle of a raging bear market is still an incredibly risky trade. Fair value works best when you have the wind of the overall market at your back.
Okay, so to wrap this all up, let's just do a quick rundown of the core principles. Remember, fair value is your mathematical anchor, not emotion. Below it is an opportunity, above it is euphoria. Always watch out for that 30% warning sign. Use euphoria as your signal to exit, not to enter. And above all else, never ever fight the trend.
And that really leaves us with the last question you should ask yourself on every single trade. Finding the fair price? That gives you a huge advantage, but always follow it up with this. Is the market actually on your side? Thanks for joining this explainer.